Hello and welcome to Generate's monthly investment update for the month of February. I'm Matthew Hanchet, Investment Distribution Manager here at Generate, and I'm joined by Greg Smith, the Investment Specialist at Generate. So Greg, we're already through the first month of 2026 and it's been a pretty eventful start to the year. What have you made of the past month and what are the key takeaways for investors?
Well, it's certainly been a really noisy start to the year, I suppose. You've had comments around Greenland, and you've obviously had renewed trade frictions as well. We've had some positive developments as well on the trade side. We've had the mother of all deals between India and Europe that covers a quarter of the world's population, but there's been a lot of sort of negative, sort of noisy stuff for investors to deal with. But I think, possibly what investors are doing, and given the start markets have had to the year, is putting aside a lot of that noise and really focusing on fundamentals. And the reality, there's a lot of positives about the corporate landscape. You're looking at earnings growth for the current season at around about 8%, which is very, very strong. And also you've got the US economy tracking at around 5% growth. I think there's also this narrative as well around TACO, or that acronym of Trump always chickens out. Now, it sounds a bit harsh, but we have seen over the past 12 months or so, lots of headlines about stuff that may or may not happen, and often it's been the least of the scenarios in terms of negativity that sort of transpired, and I think we've seen that already with Greenland. So initially it was going to be being taken by force by the US, and then that was backtracked on and in terms about making it a deal. So I think TACO's been affected there. And I think also basically the fact there's been so much noise always brings me to a quote by Benjamin Graham. He's the father of value investing, and he said in the short term the stock market is a voting machine, but in the long term it's a weighing machine. And it's really about cash flows, earnings, and how the economy is going that really matters. So I think that's a key takeaway for investors. There's lots of noise, but the important thing is if you're a long-term investor, just realise that the market generally, over time, we've seen this throughout history, climbs a wall of worry.
Thank you for that. And President Donald Trump, he's been in headlines again, and he's certainly been driving market reactions. What's your take on his nomination for the chair of the Federal Reserve, and have the markets responded positively or negatively to
that's
that?
a great question. It was a bit of a mixed response, and what I didn't mention was the Fed actually were on hold during the month. That was as expected in terms of interest rates, and in very much a data-dependent mode. And of course, President Trump has made his feelings clear about wanting to have rates go down much quicker, and Jerome Powell's been a particular target. So he's stepping down in May. So Donald Trump's nomination is Kevin Walsh. And it's interesting, he's been recently talking about the need to cut rates more quickly. But if you actually look at his track record, he's what we call something of a hawk. So he's a little bit sort of reluctant historically to actually cut rates too quickly for concern of stoking inflation. So he might not quite be the puppet, if you like, that the markets were worried about. He's actually got some other interesting views, and that AI is actually going to be deflationary as well. So I think it's a really interesting pick. On the face of it, yes, he wants to sort of go along with Donald Trump's view of getting rates down more quickly, but it might be a bit more nuanced. He's also a staunch opponent as well of money printing as well, so he wants to sort of protect the Fed's balance sheet in that regard. So overall, quite well received by the markets, well, the equity markets, but not so much for the precious metals markets. So you've seen gold and silver have been seen as a hedge against the declining confidence in the US dollar. Now that reversed with that announcement. The US dollar shot up. You had gold and silver move down by more than 20%. Gold had its biggest fall in decades. And of course, we've talked previously about how gold has had a huge run. Silver's run has been even bigger. Gold's been up around about 80% over the past 12 months. But that just unraveled really quickly. And that's a huge lesson for investors, that when you get these parabolic moves, they don't continue ad infinitum. And I think also a really good lesson about maintaining a diversified portfolio, because if you had all your portfolio in gold or precious metals, you would have been seeing some pain over the last few weeks. Just on that note as well, just maintaining a bit of balance, we have actually talked about owning gold as part of a diversified portfolio in previous videos, and we've actually had a couple of miners in the Generate funds which have done really well, and just coincidentally we'd actually been taking profits in the weeks prior to that announcement, so quite well timed. But yeah, an interesting appointment and probably a positive one near term by the looks of things in terms of the market reaction.
Yes, so very interesting indeed. And regarding to the US earnings season, we're obviously well underway. There's been plenty of companies that have already reported. What have you been seeing out there?
Yeah, so we're just relatively at the start of the earnings season. We've seen a number of companies report, a number of sectors. We got underway with the banks. That was a little bit uneven, a little bit mixed, and that continued into the technology sector. Of course, AI, we know that's been the huge buzzword for almost a couple of years now. Real interest in what companies are doing with AI, the money that they're making from AI, but also more focus as well this time around on what they're spending. And there was quite a contrast in a couple of results. So you had Meta platforms, which they own, Facebook, WhatsApp, and Instagram, doing really well. Earnings surged, revenues are up around about 24%. They're getting really strong levels of engagement. They're spending a lot on AI. In fact, they're looking to spend around about $120 billion this year, but they're monetizing it on the other side. And I think the other interesting thing about that, with people flocking to their platforms, it's a really positive sign around the US economy, and that also ties with what I mentioned earlier. There's a really different reaction to Microsoft, and they're spending lots on AI as well, but more than the market expected, and not quite seeing the returns sort of just yet. Also, their cloud division, Azure, has been growing really strongly and still growing strongly, 39%, but the market was actually looking for more, and that saw a bit of a negative reaction. So there was a couple of interesting results, I thought, in terms of big tech. Just away from tech, there was also some interesting results. Royal Caribbean, like Meta, a stock that are held in the Generate funds, doing really well. Demand's strong, pricing strong. Lots of people are still going on cruises. Yep. Another good sign around the economy, another good reaction on the day of the announcement, and another stock that we hold in the Generate funds. So yeah, it's still relatively early days for earnings season, but what appears to be clear is that companies that provide strong earnings but are also looking at their costs and being disciplined there, and also having a strong outlook, are being rewarded.
Fantastic. And moving to closer to home in the New Zealand economy, through various updates, particularly last year, green shoots was a particular buzzword of 2025, and it looks like that is continuing into 2026. Are you still seeing those out there?
Oh, indeed. And those green shoots, obviously a cliche, but I think there's not really a better one that we can use. They're pushing through the soil. And we saw that for a number of data points in the New Zealand economy over the past month. So we have our manufacturing sector expanding at the highest rate in 4 years. Our services sector, that's actually been in contraction. We've been quite a laggard there, but we're now back in expansion mode there. We're doing really well compared to global peers. Once again, growing at the fastest rate in a few years, which is really, really nice. So the recovery is broadening. Exports are doing well. We crossed over 80 billion in 12 months for the first time ever. Dairy prices, they were lagging, or they were negative for much of last year. First 3 auctions of the year have been really positive. Tourism, back to 93% of pre-COVID levels, and even the brain drain is easing a little bit as well. And this is all transpiring into confidence as well. So we had a quarterly survey of business opinion, confidence here at the highest in 11 years. Consumer confidence, that's the highest since August 2021. And business confidence generally through the ANZ's outlook measure is running at sort of 30-year highs. Now, you may ask, why is this all happening? I mean, a lot of it is obviously the green shoots that we've seen come through, but also that easing of borrowing costs that we've seen as well. So there was a little bit of a shock during the month in terms of inflation that pushed up to 3.1% in terms of the CPI. But key measures of the pain households are feeling on the cost side appear to be abating, particularly borrowing costs. And that's also transpiring itself in terms of confidence. So, really good outlook there. Also, with that CPI measure, whilst there was inflation coming through, I don't think we're at a place yet where the RBNZ will be looking at turning around and going towards sort of rate hiking. And recent sort of affirmation of that positive potentially was the labour market data. So the unemployment rate is crept up to 5.4%, which is the highest in a decade, which sounds a bit negative. But on the other side, part of that is due to the participation rate, so confidence is also returning there. People are returning to the workforce, and what that also means is that the inflationary impact will be negated a little bit as well. So we're not seeing wage pressures. So it's almost a Goldilocks scenario. We've got those green shoots pushing through the soil, and we're probably still talking about rate hikes. I think that's a story for much later in the year.
Yeah, and that just highlights the importance of diversification in a portfolio, right? Because it's no secret that global equities have done much better than domestic stocks, but as we're starting to see that starting to turn as well. So it's important that we have exposure to multiple sectors in our funds.
Oh, absolutely, and much more productive environment potentially for the New Zealand and Australian stock markets lagged last year. You're absolutely right, but if we're seeing that economic situation turn around, that's going to be a lot better story for our companies that are based here.
Exactly. Now, if we move to the earnings seasons in New Zealand, we can see that's just starting to get underway as well. How's that comparing with the US, and what are we seeing here? Any particular big companies that we're waiting with a keen interest on?
Oh, I think it's going to be really interesting overall. So we've got 32 companies due to deliver either half or full year reports between now and the end of February, and across a variety of sectors. So we're going to get a really good temperature check on the health of NZ Inc. Now, in terms of our expectations, I suppose we'll be looking for confirmation that we are at a turning point, and corporates are starting to see that. There's been a number of false starts, but as we just talked about, the economic environment is looking a lot better. So I think it's going to be interesting overall to see how corporates are seeing demand, how they're seeing costs, but also how they're seeing the outlook. But yeah, it is coming from a really relatively low bar in terms of expectations, which could allow for the prospect of upside surprises. And now just also, like when you're driving a car, it's not so much about looking through the rear view mirror, though you do use it, but it's obviously looking what's ahead of you. And similar for investors, there'll be some focus on earnings in the last 12 months, which has been challenging for a number of companies, particularly those domestically focused. But I think there'll be a lot of weight on the outlook statements. So again, if we see some positivity there, that could be really constructive for share prices and the New Zealand stock market generally.
Fantastic. Well, I think that's it for today, Greg. Thank you for your answers. They're all on balance, fairly positive, I think. Thank you for joining us. And if you have any questions, please do not hesitate to leave them in the comment box below. And as always, like, follow, subscribe, generate.